Well, good afternoon, everybody. My name is Lee Schwartz, and I would like to welcome you to our first webinar this year, specifically for dentists. You know, some call, I guess we're not quite in October, but some call October fall. Some call it pumpkin spice season. To us here at SVA, this is dental webinar season. This is our first webinar of 5 over the next few months. Today's webinar is titled Navigating Business Tax Changes in the One Big Beautiful Bill. Our next webinar is on October 21st and will be more about what this bill means for you as individuals, kind of how it affects you on your personal taxes. And then on November 20th, we'll be unveiling the results of our 5th annual dental salary and benefit survey. So you'll want to make sure you sign up for those. You can sign up at sva.com/dental series. So we have an obscene amount of information to cover here today. But just real quick, I want to say a couple words about SVA. You may remember back in 2017, we tried to educate you all as a dental community, but really the marketplace as a whole on the Tax Cuts and Jobs Act. And then in 2020, we were the leaders in making sure that you all were up to speed on PPP and ERC and all programs that were affecting dental practices during COVID. And now here with the One Big Beautiful Bill Act, which we're calling OBBBA for short, or sometimes OB3. With this passing, we are out in front again. Obviously, we have this webinar, but keep in mind, we're producing a lot of other content to help you. If you go to sva.com/OBBBA, so that's 3 B's, OBBBA, you'll see additional information like biz tips, any upcoming webinars that we do have scheduled. And we also do a weekly podcast called The Biz Beat by SVA, where we're spending about 15 to 20 minutes each week on different aspects of the bill or different issues that are affecting business owners at the moment. So as far as this webinar goes, please send in any questions you have as we go, but we are going to wait till the end to answer them. If your question doesn't get answered, please reach out to me and I will make sure one of our subject matter experts gets that question answered. So enough for me, let me introduce our speakers. We've got 2 of our most experienced people in our healthcare and dental practice to walk you through everything today. First off, we have Laura Zock, who's not just a principal but here at SVA, but also is the leader of our healthcare industry group. And we also have Joel Recklich, also a principal in our healthcare practice. He works with practice owners and practice managers on efficiency, tax, and profitability strategies. So without further ado, Joel, I'm going to kick it off to you, and I will see you guys towards the end.
Thank you, Lee. First, with OBBBA, I'm going to talk about the depreciation enhancements. So we are starting with bonus depreciation. So with the TCJA, we had 100% bonus depreciation from 2017 through 2022. And then we had a 20% phased out schedule for each of the next 5 years. So in 2023 and 2024, we had these phase outs of a 20% and 40% reduction. With OBBBA, now starting in 2025, unless you miss the first few weeks up to the 19th of January, we are now getting 100% bonus depreciation for property acquired. So with bonus depreciation, we have additional first-year deductions. Remember, you need to elect out of the bonus depreciation if you are not taking it. There is no limitation on bonus depreciation. So that's something where you could use in excess of even some Section 179 expenses. It is used on useful life of less than 20 years. It can be used on new and used equipment. One other advantage is that you can create a loss by using bonus depreciation. One thing to remember is Wisconsin is not a conforming state. So next we'll talk about Section 179. So there's been some small enhancements. So we had some phase outs. So we were limited in 2023 to about 1.1 million, which has now jumped up to $2.5 million in 2025. We also had an eligible property up to 2.9 million, and that's just now $4 million. In terms of the qualifying property, that hasn't changed. We still have the tangible personal property, software, qualified real property, which we'll talk a little bit more about in the next slide. Just remember section 179 will be indexed for inflation. The election is made on form 4562, and it's in effect starting this year. So some of the definitions that have been enhanced is, the qualified leasehold improvement property. That's just a structural inside the property. If you're doing improvements, something that you cannot take with you if you left. The big changes with OBBBA is basically identifying, it has to be non-residential building and it can be leased by the taxpayer. Another addition is, the building needs to be in place for at least 3 years in order for you to take the 179 on the real property. When before, it was in question, a lot of us thought it was about a year, but now they're just giving us a little more clarity on the eligibility of the 179 rules. So some differences we have between 179 and bonus depreciation. Remember, first off, you cannot take section 179 on rental property. So that's where bonus depreciation is definitely more beneficial. In terms of the items that you can take it on, they're both on that 15, 20 year property life. So that doesn't really change. Again, the election of it, bonus depreciation, you have to elect out of it. Well, with 179, you're reporting it on form 4562. There are some limitations, a deduction of 2.5 million for 179. Anything above that, you could use bonus depreciation. That phase out again with the total assets exceeding the threshold of $4 million for 25 when bonus does not have any. The loss creation. So if you have $50,000 of income and you take $100,000 of bonus depreciation, you'd end up with a $50,000 loss that you can report on your federal taxes. Now you cannot create that loss with 179. So that loss would be, limited to zero. You'd have a $50,000 carryover to that following year. And for Wisconsin residents, just remember, section 179, Wisconsin does conform, but for bonus depreciation, Wisconsin does not conform. So some of the key takeaways that we have, with the bonus depreciation, we do not have that 20% phase out anymore, allowing for that 100% deduction in the current year. Remember that deductions can exceed the income that you create, so you can have a loss that year to report. With the enhanced section 179, we have the increased limitations with annual inflation, and it is more advantageous than bonus depreciation for those that live in Wisconsin. The qualified real property, just more clarification, which was definitely needed. And just remember the state conformity, where Wisconsin, it's much better to take the 179. Next, we'll talk about the pass-through entity taxes. So before the TCJA and the $10,000 limitation to SALT, there was no limitation. So the taxes that you paid on your first and second home real estate taxes, as well as any income taxes you paid to your state, were all considered itemized deductions in addition to mortgage interest and charitable contributions. And then starting with the TCJA, they're saying, hey, we are going to limit the SALT portion of this to $10,000. So as you can see, a lot of states now have adopted this pass-through entity tax, which allows the passing of you to pay the corporate taxes at the state level. The advantage here is those taxes paid at the state level will reduce that federal income taxes that eventually gets passed through to the owners. This effectively restored the deduction for the state taxes for high income individuals by bypassing this SALT limitation. Now with OBBBA, the SALT limitation got increased all the way from 10 all the way up to $40,000, but there are some limitations. So there is a phase out with your income. So if your income is over $500,000, it starts to get phased out over that next $100,000, where you have $40,000 creep all the way back down to that $10,000. So you're trying to figure out, which one is better. It really depends, on a lot of different reasons here. The SALT limitations being limited for a lot of business owners, makes it still more advantageous to do the pass-through entity tax. The one main thing to remember here is the pass-through entity tax. It is an annual election. So each and every year you can figure out hey, should I pay my corporate taxes at the business level, or should I let it flow through to the individual level? Next will be the qualified business income deduction. So again, before the TCJA, there was no qualified income deduction, which was set to expire at the end of this year. So what it is for specialized service industries is you could get up to a 20% deduction on the income that flowed through the profits of your business. This was limited though. So if your income was above $395,000, there was a phase out over the next $100,000 that would reduce that 20% all the way down to zero. So if your income got above that $495,000, you'd get no subtraction on your income return. So one thing that's nice with OBBBA is that they didn't make this permanent, allowing for more deductions. There's going to be more service businesses that are going to be exempt, which we are not sure which are. There'll be businesses that have low wages or a low number of fixed assets and value. There's going to be some changes there. One of the main things to consider here is, if you're starting a practice like entity tax, selection, so if you're a Schedule C, all the profits that come through to that bottom line, can get that 20% subtraction. Well, if you're an S corporation, you pay yourself a reasonable wage, then the profits below there is going to be subject to that 20% subtraction. So you can see a Schedule C could end up with a much larger subtraction on the return. But then, we're going to end up playing the game of, property, not the property taxes, but the different advantages of by taking bonus depreciation, Section 179, the pass-through entity tax, trying to knock all these items down so you can, take advantage of the QBID deduction. Next, I'll briefly touch on business meals. Just to let you know, it was set to expire in 2026. So any business meals, we're going to have a 0% deduction starting next year. So what OBBBA did is they retained everything that's currently in place. So we have the 50% deduction for ordinary meals. Nothing lavish. Taxpayer employee must be present. Still need the documentation, date, location, purpose, attendees. The deductibility of employer provided meals remains unchanged. It's going to be in effect going forward. For entertainment purposes, that's still not a deduction federally, but statewide, you can get a 50% deduction on that. So some of the key takeaways we have, with the qualified business income deduction is, if you're a business owner, review your qualified income deductions. If the new increase phase outs affect your business, just really try to figure out, can I get into that spot where I can get that, 20% subtraction on my return. And then with the pass-through entity tax, again, that's one that's going to be a lot tougher because there are different phase outs at different ranges. We can say with pretty good confidence, if your AGI is over 500, definitely 600,000, it is going to be more beneficial. But, it also could be more beneficial if you have itemized deductions outside of zone. If you don't have a mortgage, if you have limited charitable contributions, that's where, you still might see the pass-through entity tax being a nice way to save some tax money. Now I'm going to turn it over to Laura to discuss changes in compensation and benefits.
Thanks, Joel. I think you did a great job there of pointing out what's different with OBBBA. And the point that I want to reiterate to everyone on our call or on our webinar today is that the topics that Joel covered, the depreciation 179 versus bonus, the QBID expansion and extension, and the decision on whether or not to do this state pass-through entity election on a year-by-year basis. It's time with OBBBA to revisit these. What you have been doing in your practice the last couple of years might not be what you should be doing this year and might not what you should be doing in the future. So please lean in on SVA. We're here to help you figure out what's best for your practice and help you implement that going forward. All right, now we're gonna move topics a little bit here and start to talk about some of the compensation and benefit changes that we're seeing with this new law that was passed. There's a number of provisions that are on this topic, and many have applicability from both a business and a personal perspective. So I'm going to offer a little bit of both here on this topic. And the first one that we're going to talk about is the new provision on overtime pay. Previously, there have not been any income tax exclusions or deductions that have been related to overtime pay. This no tax on overtime part of the bill was introduced as part of an attempt for broader tax reform in an effort to support working Americans. This legislation aims to include and encourage productivity and to reward workers who contribute with extra hours. By reducing the tax burden for these folks on overtime earnings, lawmakers are hoping to make overtime work more financially attractive to employees while supporting businesses that do rely on people that work extra and also with flexible workforce scheduling. So how does this new bill help employees that are working overtime? It's going to provide them with some temporary relief on overtime pay from 2025 through 2028. So this is one of those parts of the bill that was retroactively applied to all of this year. This bill affects mainly hourly employees, and qualified overtime is going to be defined under the Fair Labor and Standard Acts. This provision only applies to income taxes, as it's going to be a deduction on the employee's individual tax return. And overtime pay is going to remain subject to income tax withholdings and also Social Security and Medicare taxes withheld as well. In order to be able to qualify for this, you do need to have a valid Social Security number. The impact on the individual is that the bill creates a deduction for up to $12,500 for single filers and double that for joint filers on qualified overtime pay. Now think about overtime pay that will qualify for this to be the premium portion of the pay. For example, it's only the half of the time and a half of overtime. This is going to be structured as an above the line deduction for individuals, which means that for them, they don't have to itemize in order to get the deduction. So it doesn't matter for the individual if they take the standard deduction or if they itemize. Now, this, like many other provisions in the bill, does phase out once your income increases or as your income increases. So folks that have adjusted gross income over $150,000, if they're single, or double that or $300,000 for joint filers will not qualify for this new no tax on overtime pay. As I mentioned, it is retroactive to the first of the year, 2025. And there's a lot of questions out there about this one yet. Not a lot of guidance has been released. So we're expecting the IRS to provide some transition relief for individuals to help figure this out and support it as they figure out the details. Now, from the business perspective, are also going to see some impacts here as well. And I think the first thing is that preparing W-2s just got that much more interesting. We business folks are going to be needing to look at how we can track and record this qualified or additional overtime pay. And it's going to affect how we keep records. We're going to need to find a way to help our employees figure out, at least for this interim year being 2025, what that overtime is. Guidance should be coming from the IRS, as I mentioned, so we're all looking out for that. What we do know is that 2026 will bring reporting changes for this. The IRS has already released a draft of the 2026 W-2 with some additional codes that we employers can use to report overtime pay so that employees will have the information that they need to file their taxes and claim that tax benefit for them. In the meantime, I think what we need to have in mind is what are we doing to track this? What can we provide our employees with? Is it that we're looking at payroll and creating manual spreadsheets for this, or might our payroll providers be able to be helpful with this as well? So a couple of things to think on and mull on there in this interim period. And then I think the other thing we need to be mindful of is our employees might have questions on eligibility. Do their hours qualify? Do they not? And also why they're not seeing a change in their paychecks, even though they maybe have qualified overtime paid to them. And the reason why they're not seeing any change in their paychecks is that there's been no changes to the payroll tax tables. The IRS has not updated its withholdings estimator that many employees use to try to figure out what their withholdings should be. I think those are some changes that we're probably going to see coming in 2026, but for now, nothing's changed in that realm. All right, next we're going to look at some changes that the bill brings to us about employee fringe benefits. And there's at least one notable tax-free benefit, tax-free in the past, that has been permanently removed with this bill. I'm giving this one a thumbs down, and that's moving expenses. You might remember way back prior to the Tax Cut and Jobs Act of 2017, that a company was able to reimburse an employee for qualified moving expenses. And the benefit was that that reimbursement was a tax deduction to the business, but also a tax-free benefit to the employee. What the Tax Cuts and Jobs Act did was they suspended that tax-free part of the benefit for employees. So where do we see this often in dental practices? It was most likely something that you previously included as a potential benefit to lure or recruit employed dentists. It might have been that pre-2018 you offered to reimburse their moving expenses, and you could do that with the employee, the new dentist not having any income tax responsibility on that. But during 2018 through 2025, that wasn't an option. We can reimburse employees for their moving expenses, but it ends up being a taxable benefit to them. So often what we see maybe is signing bonuses incorporated into employee dentist packages. And part of that is meant to be, something that can help them move if they do have relocating expenses, but either way it is taxable. So what the new tax bill did was it permanently removed the pre-2018 non-taxable treatment. So essentially what we're going to be doing moving forward with this is how we've acted from 2018 to 2025 with any reimbursements related to moving expenses. They are going to be taxable to the employee that we're reimbursing them to. Now, there's also a couple of fringe benefit changes that I'm going to give a thumbs up sign to. One of them is dependent care assistance. Many of our businesses offer flex spending accounts that allow for our employees to put some of their own money, their own wages away pre-tax to help cover the cost of their children to be in daycare while we work. These limits have forever been at $2,500 for single filers, $5,000 for married filers. And as I think we all know, any of us with kids, that goes nowhere near covering our costs to provide care for our children while we work. So these limits are finally getting a much needed raise to $3,750 for single filers and $7,500 for married joint filers, which is awesome. But obviously does not make up for years of inflation and daycare costs. And I think those old limits were in place for 30 to 40 years. But anyway, we can at least look forward to an increase there. This is something these new limits are possible starting in 2026. This is not something that we retroactive in 2025. So this is something that we need to think about going forward. Another benefit that's received a bit of a bump is the educational assistance programs. Here, an employer can set up a benefit program that's designed to help your employees with tuition costs or student loans, as long as it is non-discriminatory and does not favor highly compensated employees. So for example, you might have an office manager or front desk person that you want to maybe understand business better and have some business classes, have them take some business classes to improve their knowledge. Something like that would qualify for this. These educational assistance programs are required to be written. The IRS does offer an example plan website that businesses can use to kick this off. And ultimately, the employer can reimburse an employee for up to $5,250 of qualified education expenses or qualified student loan reimbursement. And that reimbursement is tax-free to the employee. So what's new with this? Well, these assistance programs were set to expire at the end of 2025. And what OBBBA did was extend this permanently, at least permanently until, unless something changes in future tax law. And then also these amounts eligible for tax-free reimbursement will also be adjusted based on inflation going forward. So a couple of things to keep in mind with these two benefit expansions. To utilize the additional amounts for the dependent care assistance flex spending going forward in 2026, that does not automatically happen in your plan. You're going to need to adopt the change in your plan documents. So put that on your radar, keep that in mind, and connect with the company that helps you with that, with your plan administrator, so that you can get that updated if that's something that you do want to take into consideration. And I think one thing about that or educational assistance program was that really is a win-win for businesses and individuals alike, that we as businesses can help support our approved employees as they look to advance their education and learn more to apply on the job. All right, there's also some changes that I'm particularly excited about as a tax professional related to administrative changes, particularly around 1099 reporting. What we're going to see starting in 2026 is increases in the thresholds of 1099 reporting. So think about the 1099s that you are working with your accountant to prepare in January of every year, and pretty much anything over $600 paid to an individual, often an LLC, you're required to create 1099s for. So that threshold is going to be increasing to $2,000 starting in 2026. So this will cover things like rental income, royalties, medical and healthcare payments, 1099 NECs, which are paid to independent contractors for work that they might be doing in your clinic. So big picture here is that 2025 is the last year that $600 threshold is in place. All right, there's a couple administrative changes with the employee retention credit. I'm going to touch on this very briefly because we are running out of time already. Where'd that go? Main thing I think to point out here is that for anyone that filed an ERC claim, the statute of limitations to the IRS for them to audit that claim has been extended to 6 years. So they did increase the window on that. All right, we're going to move on ahead then to something that was new in this tax bill, and that is the Trump accounts. You've probably heard about this in the news a little bit. The Trump account is a new way that we can save for children in a tax advantage rates, kind of like having an IRA, but being able to set it up for your kids without them needing to have them. A couple of highlights here is that these accounts can be set up for children under the age of 18, but this is not going to be in effect until summer of 2026. So something to have on your radar and think about in the future. Parents can contribute up to $5,000 per year, and employers can contribute up to $2,500 per year. And the impact that I think we're going to see is that we essentially are able to help set our children up with these accounts and help them save for retirement and beyond sooner than we traditionally have been. There's also a business consideration to this, and that's that employers can decide to offer this as a new benefit to their employees. I'm expecting this to gain some steam in 2026 as we learn more about this, as more information comes available. But with the employer being able to contribute up to $2,500 tax-free annually as a benefit to their employees, I think that this is definitely going to gain some steam, as employers are always out there looking for new ideas on how to get more benefits and help recruit into their company. I want to point out that a written plan document is going to be required for this. And as I said earlier, much more guidance is anticipated and quite honestly needed before we can move ahead on this. All right. I think it's at that point, Lee, where we're ready for some questions if the audience has some.
I think we are, but first, you guys, that was like, I've heard a few of these presentations now. Oftentimes, this is like a full hour. You guys really packed in a lot of information, so thank you. A lot to think through. We got a few specific questions, but knowing we're getting short on time, I'm going to ask you, Laura, just one question, and that is, if you're an owner of a dental practice or a part owner, let's say, what are kind of your main few takeaways from this bill? How this is going to affect you, and where are those focus areas?
Yeah. I think those focus areas, when you look at dental owner perspective, is it's really just time to revisit things and see if everything you're doing in terms of tax planning, in terms of depreciation deductions, in terms of entity setup, is it really optimal based on now what we know is going to be in play with these new tax law changes. And a lot of these, as Joel and I mentioned, a lot of these provisions maybe have been in effect for a couple of years, but now they've been made permanent. So while we often wondered during this 8-year period of the Tax Cuts and Job Act from 2018 to 2025, what was going to stick, what was going to go away, we definitely now have some certainty on that, which is awesome. And also some newness with that too, where it's causing us to just have awareness that things need to be looked at again in order to be optimizing things. I also think too that what we covered today were some of the main business components for dental practices. Our next webinar on the individual side of things is going to be super beneficial, particularly to dental practice owners as well. So an additional plug. I hope you can all join us for that coming up in mid-October.
Laura, you're stepping all over my outro. I mean, I had all plans to talk about that. Now what am I going to say? No, so let's make sure everybody knows. You're right. We do have a couple of webinars coming up. One is, as Laura mentioned, October 21st. That's talking about OBBBA, what it means for your personal taxes. And then on November 20th is when we'll be unveiling the results of our annual dental salary and benefit survey. So please sign up for those. And a reminder, you can also go to sva.com/OBBBA, that's 3 Bs, to see additional information like biz tips and other upcoming webinars we have scheduled. Also, links to previous BizBeat podcast episodes that we've recorded and other information that you might find helpful. So the other thing I'd like to mention is if you're a part of a dental study group that would be interested in hearing more about how this tax bill affects its membership, we would be happy to come and provide a customized webinar or in-person presentation. So please reach out to me if you're interested, or also feel free to offer up other topics that you or your dental study clubs might be interested in. And just one last reminder, this here today was designed to be just a general overview of how this bill might affect you. But your business is unique. Your structure, your size, lots of other factors are going to determine how this is going to affect you in your practice. So all that to say, now more than ever, you should have a very strong tax and business advisor to help you navigate what's best for you in your practice. And guess what? That's where SVA comes in. So if you haven't been doing proactive tax planning, now's the time. We are only a phone call away. So if you are a current client and have questions, please reach out to your SVA professional. If you're not currently an SVA client, please reach out to me and I can get you the help or the answers that you need. Thanks everybody for joining us today. We hope to see you at our next 4 dental webinars, and we hope you have a great rest of your afternoon. Thanks a lot.
Take care, everyone.
Bye.